Now, let's start off with what exactly is a crash. Some crashes happen 2 years between each other. Some are 10 years, some are 7 years, some are 5 years, some are 12 years. Our current one, if you exclude the COVID-19 crisis, is nearly 12 or 13 years. Even if, let's say, you magically know when a crash is happening, the next question you have to ask is, how much will it crash? Hello everyone, welcome back to the channel, best place for long-term stock investors. Now my name is MJ and today we're going to talk about market crashes, and specifically we're going to talk about number one, what are market crashes? Number two, how do you actually predict it? When is it going to happen? And most importantly, how do you actually prepare and get ready for it when it comes to your stock portfolio? So if you didn't know, the US is currently experiencing one of its best, probably the best bull run in its history. Right? Since 2009 up to today, no big major crashes has happened, except maybe COVID. So a lot of this was driven by tech stocks such as Tesla. It's kind of like a tech stock, Netflix, Google, Amazon, and all these companies. And many people are saying that these are overvalued, so that when it crashes, when the US crashes, even if you're not investing in the US, you will also be affected. And you know, a crash will definitely come. And that's why in this video, I'm going to share with you step by step how you can actually prepare to take advantage of a crash. Before we begin, if you're interested in building a 6 or even 7-figure portfolio, do check out our free guidebook. It's going to help you a lot. It's in the description or the comments, totally free. Now, let's start off with what exactly is a crash. So if you do a quick Google search, you'll come across two very important terms. Number one, it's correction. Number two is bear market. So a correction is when the index of a stock market drops by 10% compared to its previous high or the year's high. Then that's called a correction. Then if it's more than 20%, that is a bear market. So going off that, actually we kind of already had a bear market or a crash during the COVID-19 situation because it fell more than 20%. But it doesn't feel like it because it rebounded so quickly, right? If you're in the stock market, you know. And that I think is an important point because the major thing about this video that I'm going to share with you actually is how hard it is to predict a market crash. And here are the 3 reasons why. Okay, number one, the first question you need to ask yourself when you're trying to predict or figure out a crash is, of course, when is it happening? Now, if you've been in the market for quite a while, or if you do Google search, people will always tell you that there's a stock market cycle. In other words, there's a period in which it goes up and it goes down. So that's one cycle. So usually it's 7-year cycle or 10-year cycle. So let's try and see whether that actually makes sense in history and in reality or not. So this is a chart of the US stock market going back all the way to 1870. Now pause the video and look at this chart and ask yourself, right, do you see a pattern of 7 to 10 years? Now, here's the thing, right? If you look at this closely and you're honest about it, you will realize that there's not really a correlation. You can't really find a pattern. And those of y'all who are a little bit more nerdy, a little bit more detailed and particular, you know, go and calculate the difference in time between each of these crashes. And what I can assure you is that there's no clear pattern. Some crashes happen 2 years between each other. Some are 10 years, some are 7 years, some are 5 years, some are 12 years. Our current one, if you exclude the COVID-19 crisis, is nearly 12 or 13 years, right? So it's not very clear to me, and it shouldn't be clear to you, whether or not there's like a specific cycle, like the 10-year cycle, where once in every 10 years, there'll be a major crash. So see, this is why it's important to always verify your facts online, right? It's commonly heard 7-year cycle, 10-year cycle, but a quick Google search for this image or other images, quite frankly, will show you the opposite. Now, the fact that it's very difficult to predict a crash, or rather how soon do crashes happen between them, is already a clear sign that it's actually pretty difficult to predict crashes. And there's actually 2 more questions you need to answer before I can even give you any confidence that a crash is coming anytime soon, or that you can specifically predict when it's coming. If you're enjoying the video so far, remember to give it a like, subscribe, click on the bell, you know the drill. Okay, second question you need to answer if you want to predict well a crash. Even if, let's say, you magically know when a crash is happening, the next question you have to ask is, how much will it crash? Now, I hear all the time that people tell me, hey, I will wait 50% to drop, then I will enter the market. Then I ask, well, why? Because in 2008, the previous big crash, and before that in 1999, which is the tech bubble, it fell by 50%. Therefore, the next one is also going to be 50%. Then I go in. But you see, that to me is a very narrow understanding of history, or at least stock market history. Now, so to prove my point, let's take a look at this table in front of you. So let's compare some of these crashes, major crashes over the past 100 over years, right? So in 1929, there was the Great Depression. That caused an 89% decline. Black Monday 1987, 23%. 2008 financial crisis, 50%. And our COVID-19 crisis in 2020, the stock market fell by 34%. So once again, no clear pattern. No one says that there's no law in finance or stock market that says that the market will crash by 50%. Now, this is important, right? Because at the end of the day, it's not about theory, it's about practice. So if you psychologically tell yourself, let's say, I only go into the market at 50%, when it drops by 50%, here's what's going to happen. So in the case of the Great Depression, you'll be worried because maybe you go in at 50%, then it drops some more to 89%. Will you be able to keep holding? Won't you be questioning yourself, hey, it's like, did I get it right? And so all these emotions, negative emotions starts to fill you, and most likely you make a bad decision. Now, what if it's 1987? 1987, 23%. Then you're waiting there at 50%, and then it drops 23%. Then you're like, oh yeah, it's fine, I'll wait. But then the market has already recovered, so you have already missed the boat. So again, bad idea. Now, of course, if 2008 happens again, then okay, fine, you win. But you know, just as recent as COVID-19, I hear so many people say 50% then I'll go in, 50% then I'll go in. And guess what? As you probably know, the bounce back in the stock market is so huge that after it dropped 34%, so many people became so wealthy overnight in such a short time just because they stay invested and they didn't try to predict the market. So once again, question number 2, as you can see, it adds to question number 1's complexity, and this is pretty difficult stuff basically. So if you think that those 2 questions was difficult, here's number 3. Even if you magically know when a crash is coming, how much it will crash by, the third question you have to answer, which is also very difficult, is how long it will crash by. So again, I ask people, since you say that a crash is coming, you know how much it's going to crash by, how long do you think it's going to crash by? They'll say again, just like 2008 and 1999, anywhere between 15 to 18 months. So when it crashes, let's say at 50%, I'm not going to put money in. I'm going to wait for 18 months. Then only I go into the stock market, because then everything is clear by then. So again, let's look at the facts. Great Depression. The crash lasted 4 years. So if you have a threshold psychologically of 18 months, guess what? You're going to wait a lot longer. And can you actually wait that much longer? Do you think from 18 months to 4 years, do you think psychologically you can keep holding on to it? going to be difficult, right? Especially if you've prepared your mind to say 18 months, 18 months, 18 months. Then 1987 Black Monday, it's only 5 months. So imagine if you said, I'll wait for 18 months, and then the 5th month, the market already started to bounce back. You will have missed out yet again. Now, of course, 2008, 18 months, if it happens, great, fantastic, right? And COVID-19 only took 1 month for it to rebound. So most certainly, most people trying to predict a stock market crash would have missed the COVID-19, because even if they knew that COVID-19 was a crash, they'd be like, yeah, it's a crash, but I'm going to wait. It's going to crash more. It's going to crash longer. So I'm not going to put my money. I'm going to keep my money in cash and wait for the time to come. Then I'll go back in. So once again, as you can see, it's pretty hard to predict, right? You maybe at best have a 25% chance of getting it right. Now, with all these questions in mind, do you really think that you have the intellectual and emotional capabilities to make the right decision when you try to predict a crash? Unless you're really smart and you really know yourself, 99.99% of us won't be able to do it. And the people who write about crashes in the newspapers, in online articles, they're just there to generate views. They're not there to actually give you sound investment advice. Now, here's the thing I realized. People who like to predict crashes, here's the big problem. They don't actually ask themselves or prepare and say, in the event of a crash, what stocks do I buy? What is the process by which I pick those stocks? They don't know that. So what has actually happened when that happens is that you spend all this time thinking about whether a crash is coming. You read all the newspapers, US stimulus bill, money printing, China economy slowing down and all that. You spend so much effort and energy doing that, but you have not created your own watch list to invest in when a big decline happens. So you've wasted all your time and effort, because at the end of the day, you make money by buying into good quality stocks that you prepare and know beforehand. But if you have not done any work, so given that a crash will come, and here's the thing, guys, I know I'm making it difficult to figure out whether a crash is coming, but here's the thing, a crash will come, right? Just as earthquakes, tornadoes, tsunamis will happen on planet Earth. The question is, I don't know when, and it's too difficult to figure out. But that doesn't mean you shouldn't prepare. And so the question is that, given that it will come, what checklists, right? What methods of preparation do you have for a crash? And so I'm going to share with you very briefly what you should consider when picking the right stocks. Okay, so here are the 3 basic steps, 3 basic items in your own personal investing checklist that you need so that you are prepared for a crash. You know exactly what you're going to buy. The first is make sure that you buy quality stocks. So what is quality stocks? Basically, it can be divided into 2 sections, right? Qualitative and quantitative aspects. So always start with the qualitative aspects. The first question is, what is the growth potential of the company? Is it an electric vehicle company? Is it a cloud computing company? Is it an AI company? Or is it a newspaper company, an oil and gas company, a manufacturing company? You want to know so that you know the growth potential. So that's the first aspect of the qualitative aspect. The second aspect is that you want to figure out the moat, right? So the growth potential only tells you where the company can grow, where the company can go as well. The moat tells you how likely it will go there. Is there some sort of protection or competitive advantage that the company has over its other competitors? So that's very important. You always want to start with that when it comes to the qualitative analysis in relation to the stocks that you pick. Now, the second bit is quantitative. And here, quite frankly, you have to learn accounting. And if you watch some of our other videos, you will know some of the key quantitative metrics that we look at, things like operating cash flow, revenue, net cash or net debt. So you can start there and build as you go. And very important, learn accounting, because it is the language of business. And stocks are just that, businesses. The second important bit after choosing quality stocks is to make sure that you buy it at a reasonable time, right? An investment can be bad even if you buy quality stocks, if you buy it at the wrong time. Right, just look at this chart right here in Microsoft. Right, in 1999, everyone can agree even today that Microsoft is a great company. But if you bought Microsoft in 1999, you will have to wait all the way until 2016, 17 years for you to break even. So that's why it's important to not just pick good quality stocks, but also buy it at a good or reasonable time. How do you do it? Well, this video won't do it justice, but basically you have to learn things like P/E ratios, net tangible assets. You have to learn things like NPV analysis or discounted cash flows. You need to know what we call valuation to know whether or not the company is undervalued. And when, of course, a company is undervalued, then the time to buy it is good. And checklist item number 3, diversify. Make sure you don't put all your eggs in one basket, as the saying goes, because you never know which one will win. Even if you are, even if you're really confident, you just never know, right? You could get things wrong. But the key thing is don't over diversify. Don't buy like 30, 50 stocks, right? Keep it under 30, 20. That should be good for you, especially as a retail investor. So those are the 3 key items in your checklist if you want to prepare for a stock market crash. Alright guys, hope you enjoyed the video and hope you now understand how to think about crashes a lot more clearly, and of course how to prepare for one. Remember to give the video a like, share it with your friends, and follow us on Facebook, Instagram, Telegram, TikTok, you name it. And of course, if you want to enjoy more of this sort of content, come watch some of these other videos. See you in the next video.